The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He is my good buddy out in Florida. He is a real estate expert, someone I have a tremendous amount of respect for, and I am super excited to have him back on the show today and give us an update on the real estate market. So, Jason Hartman, welcome back to the Rebel Capitalist Show, buddy.
Hey, George, it's great to talk to you again. It's been too long. These interviews are getting few and far between lately, it feels like, and I miss talking to you. It's always great. But I tell you, I've been watching your content, and it is just getting more awesome every day. It really is. But before we dive in to an amazing, maybe surprising thing for people on housing affordability that's going to shock a lot of people, I'm going to warn you. What does your t-shirt say? It's pretty cool.
Yeah, I'm kind of, as you can tell, I'm doing this remotely.
Yeah.
I'm just waiting for a friend of mine here. And I've got the old Thomas Jefferson t-shirt. You can tell this one's had some use. I got
love it, though.
And everything.
The quote is good.
Yeah, there you go.
I prefer dangerous freedom over peaceful slavery.
That's right, baby. That's right.
Good stuff. Good stuff. Well,
All
George,
right, so give us an update, man. What's going on in the real estate market? What's going on mortgage rates? I'm assuming it's still booming in the residential areas and the starter homes.
It is, I've been doing this since I was 19 years old, and I don't know if I've ever seen it this busy. I've been through many cycles, and it is crazy, George. I mean, who would have thunk it, right? As the saying goes, months ago during maybe March, right? Who would have thought this would have turned out this way? But the real estate market is just absolutely booming. I just interviewed a guy from Stansberry Research a few minutes ago for my podcast, and he was talking about all kinds of, empirical data, but he shared an anecdotal story, which I think is interesting. He has a friend who owns an excavation company. In other words, they're the ones that move the dirt around for developers. And his excavator friend, who's been doing excavating for 20 years, has purchased a whole bunch more equipment. He started his company with like one backhoe, and now he does jobs for big real estate developers. And he says he has never seen the type of land purchasing and land development at the fever pitch that he sees it now. And he just thinks that the housing market, almost regardless of anything else in the economy, and he's an analyst. He spent 23 years on Wall Street. He works for Stansberry. And he just thinks this market has another good 2-3 years of boom times ahead. I'm going to share with you some data today that I think really supports that idea. But your viewers and listeners can decide for themselves. And, you always look at things with a good, healthy amount of skepticism and a critical eye, which is important. And that's why your audience loves you. And so feel free to do that today as I'm kind of going through this. And my thesis, George, is that housing, amazingly, housing is actually cheaper today than it was back when my mother purchased her first home in, wait for it, 1976, 5 years after we went off the gold standard. It's also cheaper than it was in the fabled year that George Orwell named a book after, 1984. And it's also cheaper than it was right before the Great Recession in 2006. Now, I know what you may be thinking, Jason. This is your last time on the show because you're crazy.
No, I think they're putting that in the comments right about now, Jason.
They are. Folks, I'm not out of my mind. And I just want to, I also want to say that after doing this so long and helping thousands and thousands of investors invest nationwide and build great real estate portfolios, one told me today, his name is Keith. He's a real cryptocurrency expert and, investor. And he's a really analytical guy. He told me, he said, Jason, my Bitcoin is doing better than the real estate I bought from you. But I'll tell you, in the 3-4 years since I've been investing with you, I'm up 300% on my real estate portfolio. So he's quite happy, you know, and so we'll dive into that. And George,
Yeah.
maybe I'll just share a couple of slides with you on the screen, and you know, I'll go back and forth, so I won't keep this on the whole time. But you know, I certainly learn a lot from your show, and the Rebel Capitalist content you have is fantastic. But I also learn a lot from all the guests that I interview on my show, whether they be Steve Forbes or you know, Brent Johnson or Jim Rogers, or you know, a lot of the people you interview as well, and so that's been a tremendous thing in terms of learning. But this is interesting. Business startups, before we dive into real estate, they are at the highest level they've been since the Great Recession. So a lot of people using this time to start new businesses. And I think a lot of these companies, as the companies that were started during the Great Recession, will become, you know, some hugely successful enterprises. So we'll see a lot about that. But the question everybody keeps asking is, are we in a bubble? Are we in a bubble? That is the question I get asked all the time. It's certainly one of the questions you talk about a lot. And, you know, there's a lot of reason to think that we are. And I love the way you look at content, because you always look at a long historical history. And so this is a housing price chart, housing price index of the last 112 years. It's not a short view. It's 112 years since 1900 up to 2012. And of course, you know, you've got the Great Recession in there. You see a huge run up post gold standard 1971. A lot of inflation in the system as we went off the gold
That's
standard.
nominal, though.
Nominal. Fair enough. Fair enough. Yes. Good point. Not inflation adjusted. And then, you know, we see it go down, right? And if you look at a chart like this, you've got the Case-Shiller index compared to the consumer price index. We all know those are both maligned. Case-Shiller maligned in the sense that it profiles 20 markets for their main index. 75% of those are cyclical markets, markets we would not recommend for investment. And the consumer price index, much maligned also, but it is what it is. You know, we've got the official statistics, which are understated. We both know that, and your audience knows that too. So you can see the divergence here between housing prices and the CPI. And it would lead a lot of people to say, we're in a bubble. This is way out of sync. It can't continue, right? Even you look at the Case-Shiller index compared to the S&P, okay? And that's out of sync, right? If the S&P is a proxy for the broader economy, then housing prices are out of touch with the S&P. Fair enough. I agree. The problem is people so many times are looking at the wrong thing. They're looking at the wrong thing. Remember, nobody buys a house based on a price. They buy it based on a payment. So I'll just share with you a couple of things here in terms of our rich Uncle Jerome Powell. You know, I
Uncle Rico.
Philosophically, I disagree with almost everything he does, but he is my rich uncle. He's your rich uncle. And if he'll give us free money, I'll take it. Okay. So that's the thing. And, you know, as I've shared before on your show, to understand inflation, we got to understand the difference between nominal and real, price and value. Inflation is this insidious hidden tax. It destroys our purchasing power, but it also destroys the value of savings, and that's bad. Stocks, bonds, even equity and real estate. Inflation robs us of the profits from those things, but thankfully it destroys the value of debt, and it redistributes wealth more powerfully than anything else, because it redistributes that wealth from lenders to borrowers and from old people to young people. Why? Because old people have assets, they have savings, hopefully, and young people have debts, and so inflation destroys that debt. So here we go. 1976, the median house price, $44,200 in 1976, and the interest rate, 9.01%. Here's how that deal looked. Your house payment for that median price house would be $354 per month. Now let's fast forward to 1984. the famous book that everybody better read because sadly it's coming true. George Orwell wrote 1984, I believe, back in 1948. And he's sadly, this is all prophecy, right? It's becoming way too true. And the language is maligned, and words have double meanings, and we're being surveilled everywhere, and it's another discussion for another day.
Yeah.
$81,000 is the median house price. Interest rate very high, coming off of the Jimmy Carter stagflation era, and Paul Volcker beginning to break the back of inflation. 14.68%. Your house payment is now $1,003. Okay, but let's look at the difference. With some inflation in there, you actually got that house for $356 a month less. Okay, less. Now, I know what you're going to say, and you said it today, and it's very true. I'm not adjusting earnings in here. Earnings are not adjusted in here. Okay, this is just interest rate, house price, and inflation by the official stat. We did not put earnings into this, and earnings, just like the mortgage payment, are also diminished by inflation. Earnings are attacked by inflation. Wages, right? But look at 2006, because now interest rates are a lot lower. House price is a lot higher, $235,000, and the mortgage interest rate much lower, 6.78%. The payment is now $1,532, but adjusted for house price, interest rate, and inflation, official inflation rate, your house actually got $414 a month cheaper. People buy a house on a payment, not a price.
So you're just talking about the payment in real terms went down.
Right. The payment in real terms. Again, not adjusting wages. Okay, so, that's one thing to keep in mind. And the wage growth has obviously been uneven, right? From 1977 to 2018, Americans mostly didn't have a real dollar pay raise, largely because of outsourcing, because of understating inflation, and shipping jobs overseas and so forth, right? But it's pretty interesting. So thoughts and questions, and I'll unshare this, and then we'll get to the kind of the conclusion of this, if you will. But you probably have some stuff you want to chime in with.
Well, I think it depends on what question you're trying to answer. I think, and how you define cheap. So if you're defining cheap by a mortgage payment, then it makes a lot of sense. And as a real estate investor, I think to a certain degree you should, because you're buying cash flow, and your mortgage payment is going to be a component as to how much positive cash flow or negative cash flow you actually have. So but I think the way most people look at quote unquote cheap would be the value, or the price, I should say, not the value, but the price of the actual asset. And when you look at the price of the actual asset itself, then I think we're definitely in a bubble. I don't think that there's any way that we could argue that the actual price of the asset is cheap. The way I've been thinking about this, Jason, and I actually had this conversation with Kiyosaki the other day, and I think we've kind of gone into a time where the property, which used to be the asset, or well, let's go back. Back in time, the property was the asset, and the debt was the liability. And I think now we've moved into this weird, bizarre world where the property is actually the liability.
Yeah.
Because that's the
mortgage is the asset.
Price.
Yeah.
And the debt is the actual asset.
Yeah. George,
and it's bizarre.
It is bizarre, and it's due to the perverse financialization of the economy. And I've been saying that same thing for 15 years. Most people think the mortgage is the liability and the property is the asset. I look at it the other way around. The property is the liability and the mortgage is the asset. If I could just get a bunch of mortgages that would somehow produce income, like rent, right, and not have a property involved, I would do that all day long. I will say, though, the property, even though it requires maintenance and management, it's not it is also an asset, of course, and I know this is kind of a snarky statement, right? I get it. But those packaged commodities, the ingredients that build a house, the concrete, the copper wire, the lumber, which the cost of lumber has obviously skyrocketed, and so many of the other commodities, the petroleum products, those are cheaper now, but overall the trend is up, right? And the concrete and the labor, all of that stuff, those commodities are not indexed to any one currency. They're universally needed. They're globally traded. They're not tied to any one currency. They have their own intrinsic value, just like gold and silver. They have intrinsic value. They actually are money rather than currency, I would argue.
Yeah, I think so too. And I think to sum up the way I see what your slide deck, which is really interesting, is if you're buying for cash flow, I think there's an argument that the cash flow itself, along with the debt, could be cheap. If you're buying just the asset, though, because then you're buying it to sell it, right? And if you're buying it to sell it, then the mortgage payment itself isn't going to matter. It's going to be the nominal value or the real value of the house. So it kind of all depends on what your angle is and
Absolutely.
what your objective is. It's all like everything else. The devil's in the details.
Right. Yes, you're very right about that. And if you're buying, I would add to what you said, if you're buying to sell it quickly, you could be playing the dangerous game called the greater fool theory, which basically says no matter what I pay, some greater fool will come along and pay more. And we believe people should buy and hold these rentals because then you get the benefit of the inflation-induced debt destruction we've talked about before, but you also get the benefit of these mortgage payments declining over time in real dollars. And a couple of things I want to point out here that actually make this equation a little worse than I'm showing. Number one is that this is only the principal and interest payment on the mortgage. Remember, the property taxes and the insurance expense are higher because those
in real terms.
I think they probably are higher in real terms, because they are, well, at least.
Have property taxes as a whole gone up as a percentage of the house? And you've been doing this so long.
Yeah.
Or have you seen pretty consistent percentages as far as real estate taxes?
Well, in some places they have, but in all places they're pretty much indexed to the price of the house. So
yeah, I know they're indexed to the price of the house, but I'm talking about the percentage of the price.
In some places, and by the way, a note of caution, if people are owning or thinking of buying properties in left-wing controlled areas, Democrat-controlled jurisdictions, whether they be states, counties, cities, doesn't matter, be very concerned because most of these places are the business unfriendly places. Most of these places are the high density places, and most of these places are the landlord unfriendly places, and they are going to see even more and more suffering and desperation from governments. What I always say, George, is you never want to live under a government that is desperate for money, because what they do is they become predatory on their citizens, whether it be through red light cameras, speeding cameras, parking tickets, increased property taxes, new fees for business startups and corporations, higher state income tax, California, the poster child for left-wing disaster. They want to institute a wealth tax. And to go back to your original question about property tax percentages, California, if it stays that way, but the likelihood is it's going away, Prop 13 that Howard Jarvis got through back in 1978 saw them fix property taxes, which I have always theorized that if it weren't for Prop 13 and Howard Jarvis accomplishing that in the Socialist Republic of California, the California real estate prices would have never risen the way they have, because Prop 13 kept those property taxes in check and made it somewhat affordable
which is part of the cash flow equation.
Right. No question about it.
Just like the mortgage payment.
Yep. Absolutely. Absolutely. So
yeah. So when we started the conversation, you said that real estate is booming, but I know you take a far more nuanced approach than that. So when you say it, I'm assuming there's some segments of the market that are not booming. Let's break it down a little further and kind of define which parts of the market are really booming and maybe which parts are crashing.
Yeah. Good question. So when you had me on before and we talked about my pandemic investing course and so forth, I back in February postulated that people would leave cities and move to suburbia. Now that's like old news. Everybody's talking about it. But back in February, nobody was talking about it. Okay. So, I was first for a very short time. my 15 minutes of fame. It's over. Anyway, so certainly in urban cores, people are leaving like crazy. I just read an article yesterday about how tenants in San Francisco have one thing that they haven't had in a long, long time, and it is leverage to negotiate with their landlords. Same is true with New York City. Same is true with any high density area. So people are fleeing density, not only because of the cerveza sickness and the fear of contracting a virus in being in close proximity to people in elevators and mass transit, but also those same exact places are saddled with civil unrest. And, their mayors, frankly, in my opinion, should be indicted and imprisoned for not doing their job and protecting the property and the livelihood and the safety of the good citizens in these places whose businesses are being destroyed, windows being broken, buildings burnt down. But they can't break it up because it's nothing more than a big Joe Biden campaign rally. But I hope you enjoy my snarkiness.
Yeah, so don't buy property in the Chaz zone, right?
Yeah, no, I don't think Chaz or Chad. They've changed the name of it a couple times, or Portland or New York or Philadelphia or any of those urban environments they're very risky. I wouldn't.
Yeah,
touch them.
but okay, the outskirts of town, the residential areas, the starter homes, I'm assuming are doing extremely well.
Yes.
Okay, but the cure for high prices
is high prices. Yeah, I love that.
So, and you said that through this gentleman that you talked to, a Stansberry, he gave you that story about how his buddy's never been busier with the bulldozer and moving ground for land developers to put in subdivisions and whatnot. So when I'm hearing that, I'm thinking, okay, well, there's your supply that's coming onto the market that might put a damper on future price increases, or might just give it a bit of a headwind, let's say. How long does it normally take for that supply to start? Obviously, it doesn't happen overnight. So once they bring out the bulldozers, once they bring out the land, once the developers get through all the red tape and the regulation of the local bureaucracy, how long does it take for that supply to start hitting the market, to start bringing prices, or maybe to prevent them from continuing to increase?
Yeah, great point. And, that's the thing about real estate. It has a built-in scarcity. It's slow to be produced. It's got a lot of red tape, and you can tell it's coming. It's not like, what's the next iPhone going to be? We know one's coming, but we don't know what it'll be because it's a big secret, right? And we don't know what the price will be. And, there's all these supply questions. But with real estate, we do know in advance, right? There's a long lead time to produce the widget, if you will. And so, it's coming, but I think I agree with my guest today on my podcast. I think it's probably got a few years of tailwind behind it. Here's another thing that's interesting, George. One of our team members who's been working with us for maybe 6-7 years now, I actually put him on the podcast years ago because he made me realize something interesting. He lives in San Francisco, and he and his wife have a rent-controlled, like Victorian.
Oh, yeah. I think I've heard him on your podcast.
Yeah. Patrick is his name. And his wife's name is Robin. And so They rented this place in 1996, I think, or maybe 97, but in the late 90s. And they're paying, I think, $2,400 a month. Now that property has appreciated in value like crazy over the years. And it's probably worth, like, I don't know, I think I asked him, he said it was worth like $2 million now.
Oh my
And they're
gosh.
still paying $2,400.
1% RV ratio.
Yeah, it's terrible for the owner. But here's the interesting thing that, government intervention always perverts the market. It distorts the market, and it's a terrible thing. But this is interesting because these insanely low artificial interest rates we have now are distorting the market, but they're going to distort it even worse in the future. And here's what I mean by that. All of the millions of people that have refinanced their homes and are continuing to refinance their homes, or have purchased a new home and they've got this 30-year mortgage at like 2.4% or 2.75%. It's insane. I mean, these rates are ridiculous. They're basically getting, George, the equivalent of a super cheap rent-controlled apartment. And this is one of the things that I think makes the housing market rather stable, because these tens of millions of people, they're just going to sit there and enjoy these ultra low payments. During the Great Recession, 12 years ago.
Just so I'm following your line of thinking here. So it could prevent them from potentially selling in the future if interest rates go up, because then they'd have to sell and they have to get a new mortgage at a higher interest rate. Their purchasing power would go down. They'd be able to buy less house with the same income. So why sell? Is that your point?
Right. It's why sell, but it also gives them the ability to weather economic storms. Okay. And we all know there's a storm coming if it's not here already. Okay. I mean, you were one of the leaders and the first thought leaders back a year ago, last fall, a little more than a year ago, to really profile and expose what was going on in the repo market as it was collapsing. And I mean, hats off to you for doing that, because just nobody else was talking about it, pretty much except George Gammon. And, then it's just interesting, as I put on my tinfoil hat, we had the repo market collapsing. They tried to hide that problem, which was a real symptom of a much bigger problem, right?
Yeah.
And it portended economic collapse. And then we rolled right into COVID. And they had cover for massive money printing, stimulus, bailouts, et cetera, and all the, tyrannical stuff the government has done since then. And, but what they've given people that have purchased or refinanced a house is a giant gift of really a lot of staying power, that they can weather a storm because they've got like a bulletproof vest. Okay.
Yeah, but let's think that through.
Yeah.
And so I'm sure I've got some viewers right now that are saying, okay, well, it sounds like what Jason is saying is that the government accidentally distorted the market in a good way. And we're just looking at one. Yeah, good. That's right. There you go. Good for some. Let's think about the knock-on effects, because this keeps prices artificially high, which reduces the ability for people who are in lower income, or the millennials are getting out of college, the kids. Yeah. It reduces their ability to buy a home, which I would argue increases social unrest.
I agree. You are right.
So there's no free lunch. You distort the market, you benefit one group, and it's going to be at the cost of someone else.
It's George, what we are witnessing right now is the biggest wealth transfer in human history. I mean, it is insane. The chips are getting moved around the table, and wealth is being transferred. It's being transferred from lenders to borrowers, as it's been ever since we went off the gold standard in 1971, when Nixon finally cut the last tether to gold. And that wealth transfer has been occurring. And now we are seeing all kinds of new wealth transfers. And so what you just identified was certainly one of them. I don't want to forget to say something, by the way. As we were talking about migration trends a few minutes ago, what I think we're going to do is we're going to see this in phases. So just forgive me for jumping around. I just don't want to forget this because it's important.
Yeah, no.
Okay. So, people are leaving the urban areas, right? And rightfully so. They just don't offer much. They're overpriced. And so I think what we've witnessed now is phase one. And phase one is simply, take New York City as a great example. It's simply people leaving Manhattan or, somewhere in the city, right? And they're moving to other expensive areas. Certainly the Hamptons, right? Expensive New Jersey areas, Connecticut. All these areas have picked up a lot of new movers from the city. Now, these are people, interestingly, that have tons of money to spend. And when they go to these other areas, although still very expensive areas, most of them, their money spends better than it did in Manhattan. Okay, even though the Hamptons is still massively overpriced and too expensive. Okay, so is Connecticut. A lot of these Greenwich, right, or some of the New Jersey areas. But a lot of them move to Florida, where their money spends incredibly well, and they have this wealth effect where they feel like super rich coming into a market like Florida, right? Or maybe Charlotte, North Carolina, halfback city. A lot of people from New York go to Charlotte as well, and so. I think what we're seeing now is the phase one of people just moving to the outskirts. In the Bay Area of Northern California, they might be leaving San Francisco, but they're going to Silicon Valley, still very expensive in Palo Alto, for example, or Los Gatos, right? It's cheaper than San Francisco because you get a single family home and you get some land and so forth, but it's still very expensive. But what I think is going to happen, and this is a prediction I've made, is that we're going to see phase two and even phase three and maybe phase four of this migration trend. Okay, now we've seen a little bit of it now. Nothing's all or nothing. It's just a generalization. But the next phase will be these people sitting in their expensive place in Greenwich, Connecticut, or the Hamptons, or San Jose, or Palo Alto, or whatever, right? Then the next step is they're going to say, hey, we moved here, honey, right? They're having this conversation. The spouse says, honey, we moved here and, we got more house and all I'm doing is having meetings on Zoom. Why don't we just move to Dallas and have no state income taxes, or, Austin or something like that. And that's going to be the phase two move. And so I think we're going to see a tremendous wealth effect where people with this massive amount of spending power, because they've come from these high equity, expensive markets, and they're trading their equity. And what they're going to do is some of that extra money that they didn't need to spend on a house, where they liquidated their $2 or $3 million house, and they bought a $600,000 or $800,000 house in a much less expensive city, they're going to look around and say, well, what else do I do now? Do I start a business with my extra money? Do I put it in the stock market? Do I buy crypto or gold, or buy more real estate and buy more investment properties, right? Or, maybe a second home. So it's going to be interesting to see those knock-on effects that happen there. Of these
I think I'm already seeing that right here in Phoenix.
Oh, yeah.
Jason, as you know, I don't spend much time in the United States, but I've been in Phoenix for, maybe a couple months helping out a friend.
Yep. And by the way, I have to say, everybody, George is a saint. What he is doing to help his friend, but that's personal. So you
don't have to go into it. But I thank you. Yeah. But anyway, I've been here and I've noticed the exact same thing, because I've got some people that I went to college with that are real estate agents locally, and that almost every single one of their buyer clients is someone that's coming in from California.
Yeah.
I mean, you just nailed it right there. So I think we could, if we're not starting, maybe we're even in the middle of phase two in some areas.
Right. Yeah.
I would argue probably Denver, Phoenix as an example. Yeah. Vegas, I think, too, maybe.
Yeah. These things are hard to track because they're so fragmented, right? We're talking about millions of people making decisions, and, some of them, they move from San Francisco to San Jose, Okay, now they're not in a city, they're in suburbia. They feel a lot safer. Okay, they move from, LA and one of the high density LA markets to maybe Orange County, where I'm from, right? So they move to Newport Beach. Still expensive, but not as expensive as some of these LA areas, but more suburban. And then they do phase two, maybe they move to Scottsdale, right? Where you live. So, it's some of them are doing all of the above now, and some of them are actually moving to rural areas. They're literally
Yeah.
moving to rural areas.
Yeah, I think that's really incredible insight. One thing I wanted to get your opinion on, and I've thought about this occasionally when I'm trying to figure out the supply side of the equation with the real estate market in the United States, especially with the homes that you and I deal with personally. These starter homes
Right.
and linear markets, the cash flowing properties.
Good quality investments, yes.
Yeah, and let me just give you a quick story. I don't know if I've told you this. I'm sure I have, but maybe some of the viewers haven't heard it. When I was in St. Bart's, and I was there for the last 3 months prior to come to the United States, just to get out of the cerveza sickness, insanity, we'll call it, the mask insanity.
And I remember you sent me some real estate prices from St. Bart's. They were shockingly expensive, but yeah.
Yeah, they really are. But I was there at a dinner party with our buddy Hugh Hendry.
Yeah.
And it was over at his place, and most of the guys that he hangs out with are kind of other hedge fund guys or investment bankers or whatever. I was talking to this hedge fund guy that he likes to be very private, so I'm not going to say his name, but most people would recognize him from CNBC and whatnot. And he's also good buddies with Jim Rogers. And we were talking about real estate. So like, yeah, what do you do? I'm like, well, I retired in 2012. I got into real estate. I started buying in the Midwest. And he's like, yeah, wow, it's exactly what I started doing. And he starts going off on how great of an investment he thinks real estate is, or just in general, throughout history,
Right.
not necessarily right now.
Yep.
And he's like, yeah, I was doing the same thing back in 2012, 2013. And I'm like, yeah, well, I was doing the same thing. I went out, I bought a few homes. He's like, I bought a few homes as well. And we're like, cheers, man, tap the beers. And I'm like, yeah, I in my mind, I'm thinking a few.
Yeah.
Okay, 10, 20. To me, that's
it's a big
few.
number. I think it's coming.
I'm like,
yeah.
well, what? How much was a few for you?
Yeah.
He's like, oh, I think around 4,000.
I'm going to do the sound effect machine for that.
yeah. So but here's my point. I know back in 2000, let's say 11 to maybe 14, so much of that housing stock was bought by the BlackRocks or the huge private equity funds. Right. And I don't know if there's any statistics on how much they still own, but I'm thinking in the back of my mind that they're doing the same thing that you always do. Compared to what?
Right.
They're asking themselves that question. And if, let's say, they're getting a 6% return or cash flow from their portfolios, but we, in this weird, bizarre world, who knows what happens, but let's say over the next few years that interest rates on the 10-year go up to, let's say, 5 or 6%.
Mm-hmm.
Well, then, in my opinion, because they're really not real estate guys, they're private equity guys or hedge fund guys, they're going to roll out of their real estate investments. They're going to sell, they're going to liquidate, and they're going to roll into what they prefer, which is something in the financial economy like a 10-year treasury or something like that, or a corporate bond.
Yep.
And that might not affect the high-end market, but it may affect our market because they bought exactly what we like to buy.
Right.
These starter homes in linear markets.
Sure.
So what do you think about that? Have you got any statistics on how much they own, how much they've sold, or anything like that?
Sure. So Invitation Homes is probably the biggest, at least last time I checked. And I think they have about 60 to 80,000 homes right now. And here's the thing, George. In terms of the rental property market, there are about 16 million single-family rental homes in the country, okay, that are rented. They're owned by investors, okay? And even though those institutional investors, the numbers, talk about 4,000 homes, 80,000 homes. That's a huge number to us. In terms of the overall marketplace, it's a drop in the bucket. These guys do not
Yeah.
play much. They're not that big a force in the overall market. That's one
Yeah.
thing. But go ahead.
They're not, but in local areas they
Yeah.
are. I was reading an article the other day that this one, I can't remember the name of it, but this one big private equity group between like 2012 and 2013 bought 90% of the homes that went up for sale in like one or two zip codes in Atlanta.
You're right, but 90% of went up for sale in what period of time? I mean,
Like 2012, 2014, just like a 2-year period.
Okay, all right. Well, I don't deny that they're a force in the market, but they're a pretty small force overall. And what you got to remember is what I talk about. I teach a concept that's just sort of named in a cutesy way. It's not really quite accurate, but I call it the 3 dimensions of real estate. And what I mean there is that the rental market and the housing price market are inversely correlated. Okay. And
Usually,
yeah. What were you going to say about that?
Yeah, but not lately.
Tell me about that. What do you mean?
Well, I looked at a chart the other day, and correct me if this isn't what you're referring to, but I was looking at a chart of the vacancy rates and the occupancy rate. So vacancy rates for rentals, and occupancy rates for people buying homes. And the occupancy, or not, no, I'm sorry, not the ownership rate. I'm sorry, not the occupancy rate. So the home ownership rate was going up, was increasing, and the vacancy rate was going down. Which the chart that I saw that I think went back to the early 70s, it never did that. There was always, if the vacancy rates are going up, then that most likely means that the ownership rates are going up as well. They're never moving in opposite directions.
Right.
And the only thing that I could conclude by that is that supply is just incredibly, incredibly tight.
Well, yes, supply is incredibly tight, no question about it. And what happens, the market right now is so it's just on fire. It's very hard to operate in this type of market, by the way. People listening to me as a real estate guy, I know there's going to be, you get a couple comments always from someone who just doesn't get it, right? And they say, well, this guy is just promoting real estate, so that's why he's all rah-rah. I don't like this type of market. I think this type of market, there are 3 types of markets. There's a buyer's market, a seller's market, and a broker's market, okay? This kind of market for us, operating a referral network that people buy properties through, it's a pain in the butt. I mean, it's very difficult to operate in this type of market. I do not like this type of market. I much prefer a little bit more even keel market where there's like a balanced amount of supply and demand, because, right now we have clients that just get disappointed. They try to buy a property. There's multiple offers. They get disappointed and they just decide this real estate thing's not for me. Now most of them will stick with it because they know there's, money to be made, but it's hard to operate in this market. We do not like this type of market. Okay. I just want to put that on the record. But, a conversation I had with my friend Nancy back in 2005, 15 years ago. Okay, so here's why I tell you this. I'm at the car wash in Irvine, California, where I lived at the time. Well, I lived in Irvine at that time. And so I see my friend Nancy. Nancy works for one of the largest apartment owners in the country, Irvine Apartment Communities, owned by Donald Bren. Okay. And I said the normal thing to Nancy. Hey, Nancy, how are things at IAC, Irvine Apartment Communities? How's the rental market doing? And she says, we are not having a very good year. And I said, why? And she says, well, everybody's buying houses from you. They're not renting, and so they've had to increase incentives, lower security deposits, the rents, soften the rents, offer more, 1 month free, 2 months free if you'll move in.
So the vacancy rates were going up as the ownership rates went up.
Right, exactly. And so usually when people have 3 choices, they can buy, they can rent, or they can be homeless, right? And when I said that at one of my live conferences, someone yelled out, no, they can live with their parents. Okay, that's a fourth option. Fair enough. And I could tell that was someone who got one of the boomerang kids that moved back in, right? And so when housing affordability gets really constrained, okay, people don't buy. They're forced to stay in the renter pool, and that puts upward pressure on rents. Okay, when housing affordability is really good, they all move out of the rental market and into the ownership market. And
Right.
so then, as investors, our rents soften a bit, but our prices go up. And that's the beautiful thing about income property. It's a multi-dimensional asset class. So as long as we understand what's going on, we adjust our strategy, we either sit tight and we enjoy the increased cash flow, the increased rental income, or we enjoy capital appreciation. Either way, it's fine, right?
Or the last 8 years, you've got both.
Yeah, well, you got both. Exactly. So that's
All right,
that's
man.
that one.
Well, I sure appreciate the conversation. It's been enlightening and fascinating as always, buddy. For
My pleasure.
viewers
Before you let me
you
go,
got
though,
some
if you
more?
got a minute, I just want to show you the last slides to give you the conclusion.
I'm
okay?
sorry, I didn't know you
Yeah.
had another one. Yeah,
So-
for sure.
So let's just share the screen here again, and I think you'll like it. Remember, we left off at 2006 in our analysis. Okay, so here we have today. We're fast forwarding 14 years from the last chart. Okay, and I'll just for memory because we paused this a while. Okay, we looked at 1984, 2006. Okay, now let's look at today. Okay, and this is, by the way, from last quarter. Okay, so it's not completely current, but the median price $313,000. Everybody's thinking housing's really expensive. It's more than it was in 2006. Okay, there's a bubble.
Housing payments.
Are you sure?
I'm
Right?
going to correct you.
So,
Housing
yeah.
payments.
But look at the interest rate as of July 30th, 2.99%. That is so artificially low. It's absolutely insane. You and I both know, George, your shrewd audience knows that we are quite literally in an era of negative mortgage rates where even if you never rent out the property, with real inflation and real tax benefits because the interest is deductible on the mortgage, you are getting paid to borrow the money on a vacant house. Okay, but you're never going to keep a vacant house. You're going to rent it. Okay, so it's much better. But regardless of that, here's how it looks now. That mortgage payment is now only $1,319, rounded off. And in the last 14 years, your house payment has gone down by 657 real dollars. The only thing not in this analysis is wages. This is a comparison of housing price, interest rates, and inflation. Okay,
Right.
The house got cheaper. Okay, the house got cheaper. Now, I thought we'd go way back to 1976. That's the year my mom bought her first house, and it's a bicentennial year. It's 5 years after we went off the gold standard. The 70s were typified as a very tough decade. Stagflation, Jimmy Carter, the misery index, blah, blah, blah. We've heard it all, right? So from 1976 to 2020, the house got $299 cheaper per month.
The house
Wow.
payment.
The payment, yes. Principal and interest only, does not include taxes and insurance, okay? So is there a bubble? If so, when will it pop? Remember, it's much more complicated than this. This is simply the housing payment discussion. There are more things to it. There's everything George teaches you on his channel. There's the repo market. There's the Great Reset. There's everything under the sun. Okay. And, I'll leave that to your other great videos, George, but at least that's an analysis of real dollar housing payments. And I hope it's helpful.
Yeah, I think that was very insightful. It gives us a different angle on a kind of a Rubik's Cube that we're all trying to figure out right now.
Yeah.
And real estate is applicable to everybody.
Sure is.
Whether you're a renter, a buyer, seller, owner, it doesn't matter. So, Yeah, I appreciate it, man. Well, for my viewers who want to find out more about what you do, where can they go?
Just my name, jasonhartman.com, jasonhartman.com. You can find my humble little YouTube channel that George has helped me with. So thank you for that, George. But I'm on YouTube as well. But my big thing is really my podcast, The Creating Wealth Show. And on any podcast platform, iTunes or whatever, just type Jason Hartman and look for The Creating Wealth Show.
All right, buddy. We'll see you soon. Can't wait to do it again.
All right. Thanks again. Happy investing to you and all your viewers.